You hit 680, not by accident, not by ignoring your credit, by actively working on it, paying on time, keeping the balances down, doing the responsible things the responsible channels told you to do. And the number moved. Slowly, then steadily, until it landed at 680 and something in you relaxed. You are approved now, for things, real things. The apartment application goes through. The car loan gets offered. The credit card arrives in the mail with a limit that feels like progress. 680 works. It functions. It gets you into the room. What it does not do, what nobody told you when you were working toward it, is get you into the room at the same price as everyone else. 680 is the most profitable customer the American banking system has. Not the riskiest, not the most irresponsible, the most profitable, because 680 is the score that qualifies for everything while paying a premium on everything. Approved at rates high enough to generate maximum interest revenue, reliable enough to actually make the payments, and close enough to prime that the gap feels like a personal failing rather than a designed destination. You were not supposed to figure that out. You were supposed to keep optimizing toward a number that keeps moving. My name is Mia. I spent years inside financial services watching the 680 tier get engineered, maintained, and harvested, watching institutions make product decisions specifically calibrated to keep the near-prime population near-prime. Today, I am showing you the machinery, why the banks want you exactly where you are, what it is costing you to be there, and the specific mechanics of getting out, the most profitable customer in banking. Let me tell you what 680 looks like from the inside of a bank's product strategy meeting. The subprime borrower, below 600, is a risk problem. High default probability, expensive to service. The losses on defaults offset a portion of the interest revenue. Profitable in aggregate, but operationally complicated and reputationally sensitive. The prime borrower above 740 is a volume problem. Low default probability, but also low interest revenue. Prime borrowers qualify for the best rates, carry lower balances, and generate thinner margins per account. Valuable for deposit products, less valuable for lending products. The near-prime borrower, 640 to 720, is the profit center. Low enough default risk to service confidently. High enough interest rates to generate maximum margin. Reliable enough to make consistent payments, which means the interest accrues over years, not months, before a default interrupts the revenue stream. In 2026, the average credit card APR for a near-prime borrower sits at approximately 22 to 24%. The average for a prime borrower sits at approximately 17 to 19%. The difference, 4 to 5 percentage points on a revolving balance, represents billions of dollars in annual additional interest revenue extracted from the near-prime population specifically. Banks do not accidentally have a disproportionate number of 680 customers. They have marketing strategies, product structures, and retention mechanisms specifically designed to acquire near-prime customers and keep them near-prime. The tier is not a way station on the road to prime. It is a destination engineered, maintained, and defended by the institutions that profit from it. How they keep you there. Here is the specific machinery of near-prime retention. Because it is not passive, it is active. And it runs on your account right now. The starter card structure. The card offered to a 680 borrower typically carries a limit between $1,500 and $3,000. Not because the borrower's income justifies only $3,000 in available credit. Because a $3,000 limit at 40% utilization, a $1,200 balance, generates more interest revenue per dollar of limit than a $10,000 limit at the same utilization percentage. The low limit is a revenue optimization. It keeps utilization high, which suppresses the score, which keeps the borrower in the near-prime tier, which justifies the higher APR that generates the revenue. The structure feeds itself. The credit limit increase barrier. When a near-prime borrower requests a credit limit increase, the single most effective utilization reduction action available, the issuer faces a revenue trade-off. Approving the increase reduces utilization, which may improve the score, which may eventually justify a lower APR, which reduces margin. Denying or minimally approving the request maintains utilization, maintains the score suppression, and maintains the rate. The approval process for near-prime limit increase requests is not a neutral credit risk assessment. It is a revenue protection decision. The balance transfer offer. Near-prime borrowers regularly receive balance transfer offers. Move your existing balance here at 0% for 12 months. Sounds like relief. Functions as a trap. The 0% period ends. The APR reverts, typically to the near-prime rate on the new card, which may be higher than the original card. The balance transfer fee, typically 3 to 5% of the transferred amount, is immediate and non-refundable. The new card is now the primary revolving account. The original card, now with a zero balance, gets used again. Total debt increases. Total interest revenue increases. The borrower is in an identical position in 13 months, except now at 2 institutions instead of 1. These mechanisms are not isolated product decisions. They are a coordinated retention system, and the 680 score is the common thread running through all of them. What the 40-point gap actually costs, let me put a dollar figure on the distance between 680 and 720. 40 points. That is the gap. Less than one tier on a scale of 300 to 850. A gap that most near-prime borrowers would describe as modest, close, almost there, making progress. On a $300,000 30-year mortgage in 2026, the interest rate difference between 680 and 720 is approximately 0.6%. Over 30 years, that gap cost approximately $36,000. Not from recklessness, from 40 points. On a $38,000 60-month auto loan, the rate difference is approximately 3 to 4%. Additional cost, approximately $4,200. On a revolving credit card balance of $6,000, the average near-prime balance, the APR difference of 4 to 5% cost approximately $270 in additional interest annually, every year, until the balance is gone. Total additional cost of living at 680 versus 720 across a single home purchase, one auto loan, and 5 years of average revolving debt, approximately $43,000. Extracted in increments small enough to feel like the cost of doing business, rather than the cost of a deliberately maintained tier. 40 points, $43,000. The return on moving those 40 points is not a financial abstraction. It is a specific, calculable number that changes with every major transaction you have not yet made. The exit, the 40-point move, in 90 days here, is the sequence that closes the gap, specifically. Without a credit repair company, without a paid subscription, without anything except deliberate application of the actual mechanics. The fastest 40 points available to most 680 borrowers lives in two places: utilization and errors. In that order, pull your actual credit reports from all three bureaus at annualcreditreport.com. Not Credit Karma, the actual bureau reports. Read every trade line, every balance, every payment notation. The FTC found 1 in 5 reports contains a material error. If your report is one of them, an incorrect late payment, a settled collection still showing a balance, an account you do not recognize, dispute it in writing immediately. A single removed derogatory mark can be worth 15 to 40 points within 30 days of bureau correction. Then attack utilization. Get every card below 30% of its individual limit. Get aggregate utilization below 30%. Then below 10% if the balance reduction is achievable. Pay before the statement closing date, not the due date. So the low balance reports to the bureau rather than the mid-cycle high balance. Request a credit limit increase on every card that allows it. Both actions reduce the utilization percentage the bureau sees without requiring dollar-for-dollar debt elimination. Then request goodwill adjustments on any late payment notations in the last 24 months. One paragraph. Written to the creditor's customer service, approximately 35% succeed. One removed late payment is worth 15 to 35 points on a score where 40 points is the target gap. Run those 3 actions simultaneously over 90 days. Error, dispute, utilization reduction, goodwill adjustment. The score that reports 90 days from now will reflect all 3. For most 680 borrowers, the combined impact clears the 720 threshold before the next major financial transaction, which removes the surcharge, which stops the $43,000 meter, which makes the bank's most profitable customer slightly less profitable and significantly more free. You did not land at 680 because you failed. You landed there because the system needed you there. Needed the margin, needed the tier, needed a reliable population of near-prime borrowers paying near-prime rates on a near-prime revolving balance for the maximum possible duration. You are not behind. You've just been reading a map drawn by the people who want you lost. Hit subscribe, because next week I am going inside the mortgage pre-approval process, the rate theater, the closing cost ambush, the fees that appear 72 hours before you get the keys, and showing you every extraction point they are counting on you to miss. And I'll leave you with this. The bank wants you at 680. Now you know why. The only question left is whether you are going to stay there.